All right. Welcome, everybody. I'm John Haig. I am the co-director of the Mostafa Rahmani Center for Business and Government. And we are extremely fortunate today. We have Karen Mills with us. And Karen is a senior fellow at Harvard Business School, but perhaps as importantly, or more importantly, she was in President Barack Obama's cabinet. She was the administrator of the U.S. Small Business Administration, and she was a member of the President's Economic Council. That was from 2009 to 2013.
I thought you were going to say that most importantly, I was a fellow at the Mostafa Rahmani Center
And
for
she was a
Business
fellow
and
at the,
Government.
I was saving that for the end, but she
Oh.
beat me to the punch. So
So that was definitely the most
she was a fellow at the Mostafa Rahmani Center for Business and Government. And she was also on the President's Economic Council, National Economic Council, which maybe privately I will ask her how that worked with my other director, Larry Summers, was the chairman of the Council
Larry
of
was
Economic
the head.
Advisors.
Yeah.
I'm sure there were some interesting conversations there.
Oh, yes.
And the SBA is big. I mean, it's like 3,000 people and $100 billion worth of loan guarantees that are managed. So big issues. And also she's worked on creating regional economic clusters and gaining access, helping small business gain access to early stage capital, exports, any number of issues. I'm going to do a little bit of unabashed proselytizing on behalf of Karen. She wrote a book called Fintech, Small Business and the American Dream. I would advocate that you look at it if you want to work in this area. And she's had a number of other publications. We're not really going to do like a presentation and then open it up to Q&A. We're going to do a little bit of a back and forth, and Karen has some slides that she'll share, and we'll go through that. We'll try to leave time at the end for questions, but if something is like you just can't sit on your hand any longer and you feel like you have to ask this question, don't be shy. Just raise your hand, and we'll find you in some way. This is more of a fireside chat, if you will. We thought about putting up a fireplace on the screen, but decided to leave the slides up. So, Karen, this small business has historically been the engine of much growth in the U.S., much innovation, all of that. And a capital is critical to that. And as I said, we talked about especially working capital. There have been two major issues for small businesses in particular. One is the financial crisis of 2008, 2009, the Great Recession, and the other is the pandemic. So let's start with you were in office in the White House having conversations on probably, I would guess, an hourly basis, a daily basis about some of these issues. What was it like, and let's start with the recession. How did that go? What did you think about? What did you talk about? What did you decide to do? How did you get to that point?
Well, first of all, thank you for inviting me. I love being at the Kennedy School. I'm teaching now at the business school, but very much engaged in issues that bridge runners and folks in business and government care about. And that comes from, I guess, the fact that, in real life, I'm a venture capitalist, have been since 1983, I think, in private equity and venture capital. So I care about building businesses, but I was not really set on being in government. And in 2009, I had the great chance to go to work for Barack Obama. And we can talk about how that came about, but it was not necessarily planned, but it was the greatest job ever. The only problem with the job, of course, was the timing, because it was in the middle of the Great Recession. But I brought some Vanity Shots, which sort of addresses the question about what it was like. Barack Obama is a very smart, very thoughtful, great boss, and very much interested in policy as well as politics, maybe policy over politics in the beginning. But this is what it was like. It was work. This is in the Roosevelt Room, which is like the president's conference room. So if you go in the West Wing and you go to the left, many of you have visited or worked there's a conference room, and the president is not looking extremely happy about whatever it is I'm saying. So I'm not really sure. That's Tom Vilsack, who's back in the seat as the head of the Department of Agriculture.
I think
again.
if you didn't know what the topic was, you could look at the expression on President Obama's face and know that he's not happy.
He's not happy with it. Yeah, so I guess it was, it was a fun job. And it was a fun job. I got to fly on Air Force One. This is actually Air Force Two, because when your business is, your area is not important enough for the president, you get the vice president. So I spent a lot of time with then Vice President Joe Biden. We are in a bubble wrap company in Cleveland called Wrapped Tight. And I'm holding the bubble wrap, and those are the owners. So the job I had was tough for a bunch of reasons, but the most important is that nobody thought small business was very important to the economy. So I spent a lot of time jumping up and down in the West Wing saying things like, half the people who work in this country own or work for a small business. And that's half the jobs. And I even had Peter Orszag say, when I said 2 out of every 3 net new jobs come from small business, he said, you can't go around saying that. I said, yes, I can, because that's the numbers. So finally I said, you get your economist, I'll get my economist, we'll get in a room. Whatever number they say, it's the number. And you're right, it's not 2 out of every 3, it's 64%, and I'm rounding up. I'm sorry. And it turns out it was 64%, and of the net new jobs are created by small business. But they are not all the same. And for purposes today, when we start talking about access for capital, who is getting crushed when there is no access to capital? It's Main Street small business, which is about 4 million of the total. And it's the sole proprietors, which are actually 26 million. I have to look because we just updated the slide. And now it's 32 million small businesses, and 26 million of them are sole proprietors. And we'll come to PPP and the current crisis, but this is a growing part of our economy. This is the gig economy, and it's very difficult for them to access capital. The high growth firms that we worry about as venture capitalists are a very small number, 200,000. Now, they're really important because they're going to become the next Google. But in general, this is a categorization that we did when I came here, but it was not really well understood. So small business policy was just a mixture of options for Main Street and suppliers and high growth. And it's very important to have this categorization understood. And as I said, I came in a very tough time. So the last point I'll make is this is what happened in 2008, 2009. There was a credit crisis. Banks had gotten overextended with bad mortgages. They didn't have any room on their balance sheet, so they stopped lending, particularly to small businesses. Businesses got their credit lines pulled, they shut down, and the red line is small business job loss. The blue line is large business job loss. And the reason that small businesses lost so many more jobs is that they are credit dependent on banks. Big businesses had other places to go. And what we did at the SBA as a response is that we raised our guarantees to 90%. And this was a fight with Larry. I had to go convince him. So he said, no, you're just going to be, this moral hazard. He had a lot of words. And I said, no, we're going to be giving the best small businesses the loans because nobody is lending. And there was no actual data. Since then, we put some data gathering procedures in place. But when we put in this guarantee that we guaranteed 90% of a bank loan, it was like the hockey stick that did happen. and we did $30 billion of loan guarantees that year. And one of the things I did recently in the in the recent crisis is work with the Biden administration and the government to get those guarantees back up to 90% to make sure we could keep lending going. And then we can take it lower when we need to.
So, the natural extension, that's what happened during the kind of Great Recession. You want to take that into where we are today. Obviously, we've got this major pandemic. It's had a significant effect on small business. And you started to touch on what you're doing with the Biden administration and some other issues. But how should we think about that? And what's your take on PPP?
Well, I would walk around saying, showing this slide for a number of years saying, this is the worst small business crisis in my lifetime. And then I had to amend the slide because, of course, updated, the 2009 crisis looks like a blip. And when the country had to shut down for health reasons, which was the right thing to do, small businesses who have no cash reserves were less than a month away from being out of money and bankrupt. And fortunately, we came up with some policy solutions that Congress passed quickly and were able to put a lot of money into PPP. So those businesses were able to get by, they were able to rehire, they were able to come back, not fully, but to a reasonable degree. And then adding on to that, the loan guarantee.
Yeah, just a quick question for everybody in the audience. How many of you are, do people know what PPP means, what it stands for? Nod your head, yes, up. Okay, so we don't need to back up and say, give a little, got it. All right.
Well, I can talk a little bit about it because this is how much money that went out. The government said we will give small businesses forgivable loans. And it was a formula. It was not based on your credit. It was based on how much your employment you had. And what was interesting in that time is we had 800 billion. I mean, if you had ever said to me 800 billion and the SBA would administrate this, I would say would never happen.
So sorry, I'm going to interrupt you just for a second. So do you think that the SBA has the kind of skill set, capacity, in however you want to define it, actually administer $800 billion in loans?
Well,
what are the ramifications of the size on the institution and the function?
This was, I think, remarkable. And I have to give a lot of credit to the staff at the SBA, most of whom are career, who stepped up to deliver this. This is only the PPP loans. They also delivered EIDL loans, which are the disaster loans. And of course they didn't. But they managed to bring in some tech folks, some Amazon folks, AWS. Immediately when this was announced, it blew up, the E-Tran system, the old systems that the SBA had. And banks were struggling themselves. These are, financial institutions, JP Morgan, they were struggling to handle the volume because every small business, needed the help. But you know what? They did it. They came up with the
I know one of our faculty here, Jason Furman, basically said that the issue was so critical that you're willing to live with I can't remember if he called it a slightly leaky bucket or whatever, that you're willing to live with a little bit of imperfection given the magnitude of the problem and the magnitude of the need.
This will turn out to be one of the most important policy decisions and the best spent money. And, was there fraud that was splashed on the papers, this one and that one, greedy bad actors who went and grabbed money that wasn't meant for them. But the millions, literally millions, 11.8 million loans out of the 32 million small businesses. We would be in so much trouble if we hadn't done this. And other nations have not done it or not done it as well. And where did this money go? It went back in the economy. It's one of the reasons we didn't suffer because they paid employees, they bought, food and kept their businesses going, they bought inventory, they fulfilled demand. This is one of the reasons why we didn't suffer economically. Best spent money ever. And what's interesting is who delivered in that. The banks in this country did their best, but had a very hard time. And they tended to serve their larger customers first. And that meant a lot of sole proprietors, a lot of minority-owned businesses, a lot of Black-owned businesses were left out. And there's a really interesting paper that shows what happened. This is done by Sabrina Howell, who's an economist at NYU, and it's absolutely brilliant paper. She put it out in the NBER, looking at who made the Fintech loans to Black-owned businesses, who made the loans to Black-owned businesses, and Fintechs, the new providers, provided the majority of the loans to Black-owned businesses. And so what you see here is the opening the door of a new distribution system of access to capital that is, it's just more accessible with smaller businesses, smaller loans. If you look back on the other chart, the other thing is, if you look at the fintech piece of the pie here, they did a much smaller number of the dollars than they did of the number because their average loan size was much smaller. Why? They were automated. It was just harder. And the big banks wanted to serve the big customers first because they were the more profitable customers. So who was going to make the $12,000 loan, the $32,000 loan? Not so much the banks.
That's really interesting. I mean, so that's a natural kind of transition to, part of what you write about in your book, that this credit gap, if you will, this problem of the credit gap. And I know during the Great Recession, you had a number of banks failing. And so you had the need to fill that credit gap. And you were talking about one of the things that makes it so hard, and you've alluded to it here with kind of different sizes of the groups that were served, but this issue of, you talk in your book about information opacity and heterogeneity. And, that fintech has the capacity to step in and address that issue. But could you talk a little bit about what those two things mean, and then we can shift to like, how can fintech help solve the problem? You've already kind of touched on it a bit with just what you just described.
So I think this is what you're referring to, which is, why is it so hard for a small business to get a loan? What about these terrible stories of, Xeroxing a pile of paperwork and walking down the street and waiting 3 months for an answer, and then no is the answer. And then you have to walk down the street and get to the next bank. And by that time, you're out of money. It's just too late. So why is it so hard? Because there are these frictions. And the two frictions that I really think have identified is this idea about information opacity. If I give you 10 data points about a consumer, you can tell if that consumer should get a mortgage. If I give you 10 data points about my small business, you have no idea. Am I profitable? Should I get this loan? What am I going to do with it? It's just much more complicated and hard to see inside the small business. But big data and some of the things we're seeing in artificial intelligence solve this problem. The second friction we already talked about is heterogeneity. All these small businesses are different. One day you're lending to a dry cleaner, the next day to a car repair operation, the next day to a parts supplier. They all have different characteristics, and the poor banker has to get in their head a credit file of what makes a good, usually I say what makes a good dry cleaner. But if you have a data set of 1,000 dry cleaners, you can pretty well tell whether the 1,001st dry cleaner that you're looking at is a good dry cleaner or a bad dry cleaner. So we have a moment where technology, particularly with information and data, has the ability to change the game, to alleviate these two frictions.
So just out of curiosity, is it more, like I could imagine this has two dimensions to it. One is what you started with, which is like, I'm a small business, I got to fill out, you know, all this paperwork, and there's just the burden of doing that. And then there is the quality of the data that the bank gets. And it sounds like you're saying this, the fintech can help solve both of those problems.
Yes, fintech and automation seem to solve both of those problems. And in Sabrina Howell's paper, it also shows that when banks automate, they start serving more Black business owners. So it may also solve some of the disparity, some of the bias that appears to be hurting access to capital in some underserved markets.
So can you give us a little bit of a sense of who these fintechs are and kind of how did they come into existence and how did they get capitalized and who are they?
I'll just ask the folks in the room, anybody interested in fintech, going into fintech and the rest of it? Yeah, I see hands. It's wild now. I mean, if I ask this question at the business school, I would say I get half of my class. So the landscape, I've been adjusting this slide for a while, and now we can't fit everybody on it, but the landscape for who is going to win in this new tech-enabled lending thing is just gone crazy. Banks are have some advantages, so they're not going away. They're buying fintechs. American Express bought Cabbage. Big tech, and I stuffed in things like Square already into big tech. They have possible advantages. They have trusted brands. They have all the customer interactions. There are challenger banks popping up everywhere who are only online, and they're in the US, but they're really all over the world. And then you have my personal favorite, which is fintech infrastructure companies. So think Plaid and Stripe, who are working in the background to create new rails, new processing systems, new intelligence, all kinds of products and services that might be used by any of these other players to enable not just lending. Fintech is a large array. I try to take this narrow small business lending lens to it, but these infrastructure layers are changing, across everything, including crypto.
Right.
So I think this is a wide open landscape. I always ask who are going to be the winners and losers. Maybe we'll get to it later. But I get people voting for each of these.
I would be curious. I mean, let's ask. Feel free to raise your hand or not say anything, but I'd prefer you say something. So I don't know how many of you are
nice.
familiar
I always
with this
say
landscape, but
you have to vote.
yeah.
Yeah.
Who's going to win? How many people put their money on banks and credit cards? I'll just ask. We'll go through all four of them and just raise your hand when I hit the category you think is most likely to win. Banks and credit cards.
Do we have any of the online people? Are they waving?
We'll see. I don't know if they can wave or not, but big tech, fintech, infrastructure. Yeah, I don't think they're necessarily mutually exclusive. And I mean, okay, so I was a management consultant for 14 years. I'm not your typical academic. I ran AT&T Wireless's emerging initiatives, which is basically new services. So I dealt with a lot of new tech companies in the mobility space.
So who do you think?
And this is the Wild West. And my problem is, I have a view, but I want to hear your view first. I'll go first if you want me to, but I'll just tell you. I think that this is not the landscape you will see in a decade.
Oh, interesting.
Right? Because I think you're going to see a lot of partnerships and mergers and acquisitions. I think there's a big question about how much will the government antitrust lawyers allow to occur. But if I'm a bank, I know I don't have the expertise of a fintech or an infrastructure player, but I know to deliver the kind of service that I want to deliver, I'm going to need that skill set. So I either have to build it internally or I have to go buy it. Okay. And I think this will, in 10 years, this will look completely different. And you'll have fewer players up there and you'll have businesses that are built by combinations of these companies. And that's to me the interesting question is like, how is this? And that was going to be my question to you is like, how do you think this is going to change, evolve?
I'm so glad we're having the fireside chat because I learned a lot from this moment. And I think your perspective is right. When I wrote the book 3 years ago, I thought we would 3 years in the future see some winners and losers emerging, and we haven't yet. And I think part of the reason is what you described. We haven't seen the sort of full array of the solutions and the mergers. I also think there's a big regulatory question here, and it adds to the complexity because you would think that big tech, a lot of you voted for big tech, and big tech has been a little bit reluctant to enter because they have other more profitable markets and they don't want the regulatory oversight and they don't want to engage as banks. And it turns out Square and others have realized that you have to be a bank in order to really compete here. So why? Because of deposits. And I'm talking really in the US context, in the US regulatory context, because it's a bit different elsewhere. But in the US, we have this fabulous banking system. They are overseen with a lot of regulation, which they complain about a lot, but it also allows them to do things that other people can't do. And one of those things is they can take deposits and pay you for your deposit pretty much at the moment, nothing.
In real terms, probably they're being paid.
Right. So it turns out that they have a big advantage in their cost versus the neobanks who are getting their money from the markets, from hedge funds, from whatever, and paying 10 percentage points higher. So I am all for the banks because they were my partners at SBA. And we have a real asset in our regulatory system, but we have to think hard. They, of course, don't want the fintechs to be chartered because that's competition. The fintechs thought they were going to have regulatory arbitrage. Oh, we're free from all this. No, no, no. Turns out now they all want to be banks or at least get a charter and be able to take deposits. So we did a seminar for the Fed 2 days ago, asking exactly this question and discussing what should be the oversight in this new marketplace to ensure safety and soundness, but still have innovation and get to this customer solution. So I think that's the interesting overlay to the question of winners and losers. It kind of depends on what the Fed does and what other regulators
Right, absolutely. So I'm
do.
going to extend my comment,
Yes.
and then you can react to it. And we're all a function of like where you stand depends on where you sit. And having my experience that I had, I don't have a lot of faith, believe it or not, that big tech can adapt quickly enough and clearly enough. And I'll tell you that for two reasons. One is I have a son that works for Google, and he's getting progressively more frustrated by all of the administrative choices that he has to work. He's a product manager and trying to get things through the system. And he's like thinking, maybe I probably shouldn't put this on Zoom, but it's like, do I really want to put up with this administrative hassle, or do I want to go to a smaller startup where it's more nimble and faster and quicker? The other is my experience being in a big company at AT&T, and in the mid 90s, trying to persuade them that IP was the future, internet protocol, telephony was going to happen, and we needed to be more aggressive. And my story, I apologize for taking the time to do this, but my story is, how many of you have ever heard of AT&T WorldNet? Oh, the person I would expect to know is in the back, right? AT&T WorldNet was AT&T's email system, and it was one of the first email systems out. And it was wildly successful, and it had been carved out from the core businesses. and allowed to operate much more like a startup. And we understood really well network effects and how more people on the system, the better, the more interoperability and all of that. And we were going gangbusters, and the head of the consumer unit routinely would stand up and scream at us. Literally, I mean, he was screaming at us that this was an essential part of his bundle of telecom services that he needed to sell to consumers. And he finally persuaded the CEO and chairman, Bob Allen, that it should be in consumer. It got moved over to consumer. And the first thing he did was put a price on it and raise it. And WorldNet died. And you've never heard, most people have never heard of WorldNet. And that's my concern about big companies. So that's what I worry about with, like, are the banks going to be able to adapt? Big tech going to be able to adapt? And I don't have a lot of confidence. The last story I'm going to tell you is one of our fellow grads from many, many years ago is a guy named Barry Sloan. Barry Sloan just sold his community, regional bank, and his conversation with me was he doesn't think community banks are going to be able to survive, that the fintechs, whether it's big or small, are going to overwhelm the banking system of the community banks anyhow.
So I disagree with Barry, your friend, because I actually, if you ask me about the winners and losers, I'm going to bet on the community banks. And the reason is that I think if we get the regulation right, particularly the third-party connections, and you have a plug-and-play system into the core system of the core banking systems, then a community banker can go back to doing what they do best, which is have a relationship. So my maybe optimistic view is that the community banker goes back to relationship banking, that the technology infrastructure becomes more available and commoditized if we've got good interfaces, if we've got plug and play products. And once again, the reason is there's an array of banking products that a customer wants. And if a bank can figure out how lending plus relationship advice plus other deposits and things can be part of a package, I think that they could be successful. Big banks are interesting because I think they suffer from the point you raised. Jamie Dimon, who's been here a bunch of times, I actually interviewed him in the forum, and he's brilliant leader, but he's spending $12 billion on technology this year. Last year, $9 billion. Before that, $9 billion. You would think with all those billions, he could get this right, but not so far. Not so far. It's
Right.
a bit of a mess.
Right.
So I think your issue about large companies not being able to be nimble certainly is proving to hold back some of the advantages a Bank of America or a JP Morgan should have in just, sort of jumping into this and solving the problem.
So not to dwell on the academic literature, but if you want to kind of two different perspectives, go back and read Schumpeter, who's going to tell you that big companies are the innovators and that you need to have this creative destruction process. And then go read Ken Arrow, who gives the alternative version that basically it's really small businesses that are the innovators and drivers. And it's an interesting read. You can kind of get the balance of perspectives. The one thing that you said that I would completely agree with is that if the community banks can find a way to build a relationship with the infrastructure companies, possibly the fintech companies, then they can do what they do well, which is marketing and relationship banking. And then they aren't competitively disadvantaged because they've got the fintech infrastructure to deliver services. It's not just the kind of deliver services, it's doing it efficiently with better data. So that would kind of be my take. But I'm fascinated to watch how this plays out over the next decade. And I encourage all of you to go into the fintech space and solve this problem, whether it's in the government side or whether it's at a company.
Well, there is a big reason to solve this problem besides the fact that, you can start a new company and make a lot of money. And that is that if we take away these frictions and barriers, to your Schumpeter thing, we get a higher rate of entrepreneurship and a higher rate of success in our entrepreneurial companies. And this includes the Main Street small businesses and the sole proprietorships. Now, I know that they are not going to be the next Googles, but in our country, they are really the path to the American dream. This is, how we traditionally have given access and opportunity. This is a story of my family, immigrant family comes to the country, starts a business, provides for the family, builds, you know, employment for lots. That's what we do here really well. And if we figure out this access to capital and we take away the frictions and barriers, particularly in underserved markets, then I think, you know, we solve a lot of issues besides that are plaguing our cities and our communities.
And I'll put my last kind of piece of punch on the table about, and maybe it's just that I'm thinking about this a lot now, but the importance of standards.
Yes.
Because one of the things that enabled telecom and mobility to advance the way it has is basically this structure where data networks and data applications can be separated in the what are called APIs. The interfaces between the layers are open, and so you could go out, for example, in the AT&T when I was doing mobility and wireless, I ran emerging initiatives for AT&T Wireless. Because it was open, you could go do a deal with a guy who's running something in a garage, an application that's going to be critical potentially. And that was because of the open standards. And I think that's a big issue for fintech and infrastructure and the relationship to banks, how much that structure is porous and fluid and how much of it becomes rigid. And my experience was walled gardens don't work very well. They usually don't last very long. And if the big tech or banks try to do kind of what I call walled gardens, and I'm happy to explain that if people want more, but I think they're going to struggle because I think ultimately this will be more an open system. I hope.
Well, before we go to questions, I want to add to that point because standards are, as we were discussing earlier, some of the least understood but most powerful factors in competitive success, in policy. And I think one of the best jobs in government is the head of NIST, the National Institute of Standards and Technology. It is a part of commerce, has a big campus in Bethesda. It has 3,000 people, but it sets the standards. And I think if you have that power and you figure out how to set the standards, works a lot in cryptocurrency and working in cyber, working in lots of these areas. But to your point, I think there's a question about why all this is happening right now. And it's because the technology and particularly the APIs enable you to have these pipes that suck up the data. And one of the big questions now in the regulatory scheme, there are a whole series of questions. So the enabling technologies are the APIs and the AI, and that gives you all these products and services that, create lender insights and customer insights where you can look inside your own business and see what the cash flow is and maybe avoid a life-threatening, moment where you run out of cash. But the dark side of the black box or the regulatory challenge is each one of these creates not only questions about standards, but worrying about adverse consequences, disparate impact, redlining, figuring out what's in the algorithms. What happens if I suddenly get denied a loan all the time? Well, I can say, well, what's in my credit score? There must be a mistake. And I have the power today through regulatory oversight to say, show me what's in my credit score and correct the mistake. What happens if it's an algorithm? What happens if it's a machine learning derived formula that nobody can even tell me what's in there? How do I correct a mistake? How do I get transparency into there? And then there's a whole series of questions about who owns your data. Once again, to your standards questions, who has access to it. All of these are being faced by our friends, the regulators. my favorite chart, which is actually from the GAO, the government office, and this is the regulatory system for small business lending. There are 7 federal regulators plus 50 state regulators. So there's 57 regulators who have to get together to figure all this out. I call it spaghetti soup. That went over big with the
So
Fed.
I have to tell you, so I didn't know the slides that Karen had, so you've anticipated all my questions. And the only request I have is I'd like a copy of the slides
Yes.
when we get
All right,
done.
we'll post them. We'll send. You've got them. You can post them if you like.
But it, there is this issue which you're starting to talk about, which is like this algorithmic bias and questions about privacy, and that's a mishmash. Okay, and you've lived in the federal government and you've lived in the private sector. So institutionally, kind of how do we solve this issue? Do you think it's possible for these state and federal regulators to get together in some way to articulate a kind of rational regulatory structure in this area?
Now you're testing my optimism because I'm an optimistic person. As I was writing the book, I went to speak at the Convention of State Regulators, State Banking Regulators. And they were suing the OCC, the Office of Controller of the Currency. So the state regulators were suing the federal regulators over giving fintech charters. And I said on the stage that I was the only person in the room who thought that the fintechs should get a charter. And the interviewer said, well, I guess this interview is over. And he was only like half kidding. We did continue the interview, but they were not happy. And they've resolved that dispute, but they really are having a hard time convening. And that's one of the reasons why other nations are ahead of us on this. In the UK, there is a very distinct regulatory structure that handles this. It was created, George Osborne, who was the controller of the currency, created it in the financial crisis to bring innovation. They only had 4 banks doing small business lending. They were all in trouble. So they did that to create challenger banks. They developed the fintech sandbox, regulatory sandbox. They are working in a model that, provides us good information. And what I say to the regulators now is we have to coordinate, but we are not on our own to figure this out. We have many nations who are working hard. They've made some good choices. They've made some errors. We can learn from this. And I think we can get this right. It really is a matter, it's a matter of hard work and coordination. But there is the will to do it. It's just our system is just not set up for it at the moment.
So I'm gonna
maybe all of you should be regulators.
I'm gonna
That's
open
a really
it up
good
to
idea.
questions.
I like my idea.
I'm gonna open up to questions. I do have. Okay, I apologize. I have to ask this question because there is this issue of first mover advantage in regulation. And when entities are operating on a global basis, are other countries going to set the regulatory structures for the U.S.? And the reason I raise that, I'll give you an example. So the EU was the first to introduce GDPR. And then that became a model piece. GDPR is the data privacy regulation in the EU, right? So then that became the template that California took to establish their law. And then Microsoft comes out and says, it's really hard to build a lot of IT infrastructure supporting this kind of legislation. We don't want multiple forms of that around the world. Can you please find a way to develop a common approach, much like the EU? We may agree with some of it and disagree with some of it, but we'd rather have it consistent. And all of a sudden, the EU has set the regulatory standard with GDPR. So what do we do? If we don't solve this, are we giving up the landscape to some other regulatory entity?
Yes.
Okay, that was easy. So
yes, I think so. And I think it's happening right now in open banking.
Oh, all right, questions. We'll start in the back and work our way forward. So I'll get to you.
biggest concern is Amazon. Amazon's getting into so many different industries. At the same time, they want to be a fintech. So they're going to have a lot of control in a lot of different areas, and that's a scary part. That's a scary thing to think about.
Make sure you speak into the microphone. Claire is going to around because we've got people on Zoom. People can hear you.
Right. And do we want to take a couple questions and I'll speak to them? And say your name and
Yeah, your name. Well, here we'll do forum like rules. Say your name, your affiliation, question, question.
So my name's Sam. I'm a first year MPP at the Kennedy School. Um, I'm doing an RA job with John and a few of his senior fellows actually. Another job that I have is working with Professor Latanya Sweeney at the Data Privacy Lab. And we're basically tackling this, concept of information opacity and open data interoperability, but more in like a healthcare context. So how we can start using banking data, social media data, healthcare data for better healthcare outcomes. And it seems like a very similar application, but to understand borrowers. I'd like to understand kind of maybe your insights as to how fintechs or even banks are starting to use like social media data or healthcare data. So data that's like totally not related to finance, and whether they're doing that right now or whether there's any potential for that.
One more question.
yeah. We'll see. You write them down.
Hi, my name is Richard. I am an MBA MPP between the Kennedy School and the Business School. Yeah, thank you for this wonderful talk. I'm also doing a little bit of work with Tim Masad, who's a senior fellow here. And my question is around the SBA and kind of what they're doing right now. I'd be curious, as their balance sheet has expanded, their responsibilities are now massive. Curious what you think the current administrator of the SBA is most focused on, maybe 2 or 3 priorities.
Are you saying
SBA.
SBA.
Oh, SBA.
Yeah. SBA. Great. Well, 3 completely different questions. I think I'll start with the middle one, which is what kind of data is floating around there in these algorithms. And I think we are, I work with a number of interesting companies, one called Enigma, which is a data aggregator. And I think the data that is getting aggregated right now is not so much social media data. It's much more related to lending. It's much more related to what goes in and out of your bank account, how many other credit. It tends to be more traditional credit data. And it's also data pulled from public sources, like how many citations did your restaurant get by the health department? So aggregating the data that exists at this moment that's not proprietary like healthcare data is certainly sort of a wide open field. And we don't know yet if this new data on cash flows particularly is a better indication of creditworthiness, but the initial work seems to say that if you know the cash inflows and outflows of a business, you tend to be able to have a better prediction of whether they'll be able to do loan repayment. So those are the kinds of things people are focused on. Turns out it's a harder algorithm to write and to test. People are worried about bias. You can't use zip codes. What else are you inputting that has bias in it? There are a couple of areas, there's sort of 3 major areas we talk about of data, social media. People are doing that, gathering all that stuff for a whole set of reasons. Financial data and healthcare data. People are much more sensitive to financial data and healthcare data being out in the world than they are for their social and shopping histories. So at the moment, I think that, you know, the focus around it's your money, we should have more stringent criteria around it, is something that regulators are taking seriously, but they haven't really solved. And I think if you are thinking about data privacy, healthcare is clearly, you know, a place where big data is going to play a role, but it has important privacy implications. So we're at the beginning of a very complicated road is sort of my answer. On the SBA, the administrator right now has a very clear focus on the administrative challenge of dealing with 800 billion of PPP plus another, I can't remember, billion of idle loans. And lots of people who are trying to get forgiveness, who haven't gotten it, are caught up in some, you know, administrative or computer glitchy moment. And there was tons of fraud because, as Jason Furman said, it was better to get the money out. And we've learned lots about fraud and fraud identification that I think will be very useful for next time. But, you know, she's got to clean up a big set of messes on that. So I don't see her. So in my tenure, I spent a lot of time with Larry Summers as part of the White House economic team. And I traveled a lot with the president for the recovery. I did a lot with the vice president on the Recovery Act. And was considered, you know, part of the National Economic Council. Larry actually made that happen. And I think now it's more led by commerce, and Pete Buttigieg in transportation is taking a big role. We had a great cabinet, you know, a really sophisticated, hardworking, integrated cabinet. We're all still friends. We used to have ladies' cabinet dinner. We talk about, the president said, "What do they talk about?" He asked Valerie Jarrett. He said, "We talk about you," which we actually didn't talk about him, but we had a lot of fun. So it was very much economic focused because we were trying to recover from the financial crisis. And I think she's got her hands full. I think she's doing a terrific job, but you know, she's got and along the way, she's going to improve systems and get rid of some of the antiquity that was, you know, sadly part of being one of the low-level agencies and not viewed as important. And you know, we got more money and increased budgets. I had the good fortune of having Olympia Snow as the Republican on the Small Business Committee in the Senate, and Mary Landrieu as the Democratic senator. They got along really well. I think it was the last gasp of real bipartisanship. We got a lot of legislation passed. We got a lot of things fixed in the agency, but those sorts of things don't really happen at the moment. And the last set of questions was really about Amazon and also about bank consolidation. I am not actually as worried about either as you have described. The reason is that if we get the bank chartering right, I actually think we're going to see more new banks. They might look different, but we're going to see a lot of entrance into the banking world. And once again, I think this will provide a different alternative. So some people might go to a neobank. They don't need a branch. And then the community banks, I think, will find more and more ways to be profitable. I've joked about starting a bank now, but I don't actually think it's such a bad thing to start today a community bank. Amazon has, I've actually worked with Amazon and their triple secret, whatever it was. I'll probably get shot for now admitting that. I think you're not supposed to say anything, but you know, they have not shown an interest in really doing financial services. They got a lot more. They could, but they are not at the moment the player to watch. And if they decide to be the player to watch, they're going to have a lot of competition in this area, as it turns out.
All right, we have a chance for one last question, which if nobody raises their hand, I'm going to ask a question. Okay, so this is a little bit out of left field. So one of our faculty members, Asam Khwaja, who does economic development, and there are a number of people in developing countries who are looking for microfinance. And he did this study where he took not the they don't have the traditional method, and they're analogous in some ways to like ultra small businesses, and they don't have a credit history. Okay, and so it's very difficult to predict whether they're going to be successful or not. And he identified a bunch of behavioral characteristics that could be used to determine their creditworthiness. He tested it in one country and found it was highly predictive. He tested it in another country, and he's publishing this in like the Quarterly Journal of Economics and all of that. And at one point, he came to me and said, "John, I have a problem." This was when I was the executive dean. And he said, "The problem is banks are coming to me now and wanting me to institute kind of credit checks for microfinance based on the behavioral characteristics of individuals." Now, at one level, that sounds great. And is there an analog for how some of these fintechs could build their businesses? The downside of it is to the question that came up earlier about data and kind of the types of data you're collecting and how much information do you have on an individual, and is that troubling? And how do you think about that balance? So it's
I have to
completely
say-
out of left field. I mean, sorry
Yeah.
about that.
So I'm not an expert in non-US because it turns out the fintech world in the developing countries is exploding with companies and ideas and innovation and algorithms and it's actually quite different dynamic than what's happening in the US, where we have all these banks and we have different frictions and barriers. So I'm not an expert, but I do kind of watch it. And what we see is all kinds of information getting pulled. How much time you spend, on your application turns out to be a huge predictor of fraud, for instance. How much time you spend, and creditworthiness. Certain fields that you fill in, there's all kinds of correlations that people have made. I don't think anybody has figured out the full causality of the creditworthiness model. And I'm sure there are dangers in whatever they figure out. Ben Roth and Natalia Rigol at the business school are working in Chile. They're working in India on similar kinds of things with banks there. And there is tremendous promise and tremendous risk in what you've just described. And so the question for oversight and regulation is, how are you going to create a transparent environment where if these algorithms get everything wrong, you get to go in and say, "Oh no, I dropped my phone. That's why I didn't spend any time."
Right.
Whatever it is in the algorithm, you have a chance to modify, amend, and that we do understand, this is true in lots of these things, including facial recognition. We do understand the biases, the unintended consequences, and the way that technology may or may not, produce the intended outcomes that we want. So it's a complicated area, lots of promise, and I think many risks.
All right, terrific. I would like all of us to thank Karen for coming over. You managed to make the trip over the bridge in spite of the cold weather and the wind, so we appreciate that. And thank you all.
Thank you for having me. It's always
Yeah.
nice to be here.
And thank you all for coming.